Imagine a market, any market. Buyers and sellers clash, prices move up and down. Chaos? Not quite. Look closer. In this whirlwind of trading, patterns emerge. One of the most important patterns is support and resistance. These are price levels where the asset's price tends to stop and reverse. Understanding these levels is key to successful trading. Think of support and resistance as battle lines in the market. Bulls push prices higher, bears push them lower. Where these forces meet, support and resistance levels are drawn. Support is the price level where buying pressure is strong enough to stop a downtrend. Imagine it as a floor for the price. At support, demand outweighs supply. Sellers are hesitant, buyers see value. This creates a price floor, preventing further decline. Several factors can create support levels: previous lows, psychological levels like round numbers, or even trend lines. Resistance is the opposite of support. It's the price level where selling pressure overpowers buying, halting an uptrend. Picture it as a ceiling for the price. At resistance, supply trumps demand. Buyers hesitate, sellers take profits. This creates a price barrier, preventing further rise. Similar to support, resistance levels can be created by previous highs, psychological levels, or trend lines. Traders use support and resistance levels for various purposes. These levels help identify potential buy and sell zones. When the price approaches support, it's a signal to consider buying, hoping for a bounce. Conversely, when the price reaches resistance, it's a signal to consider selling, expecting a drop. However, remember that support and resistance are not foolproof. Sometimes the price breaks through these levels. That's why traders use other tools and indicators to confirm their decisions.